Hi guys, hi Shannon. You asked for this video, so I mean, really, anyone could be referring to Carol and Allison as well. But Shannon asked just for, I imagine, a sort of just a gentle talk through the VAT return. I guess what I really want you to do is to maybe send me a question that you didn't like or something along those lines, or maybe you just want a general refresher, just a general talk over it. Right. So I'm using this work sheet that comes with the program for indirect tax. I'm not sure if Mohit uses this one. He's probably done this question already, but this is a good illustration, if you like, of a VAT return. Now, let's kind of be fundamental about it. We're really still talking about double entry, if that gives you any kind of confidence. It's the base of all of this, ultimately. The key point here is when we talk about this idea of a sales day book, if someone walks into your business or your organization and hands you over a total amount of £4,489.20, really, in effect, they are giving you, in addition to what is yours, they're also paying a tax levied by the government. So you are, for a short period of time, keeping some money for the government, so you owe the government. This is a liability. I'm sure you know that already. So you can already sense that your double entry will look very much, if you like, yes, you have revenue, because revenue must be to do with what you as a business has generated, which of course must only be the 3741. I mean, this is income. You cannot declare the whole thing of VAT as income as well, as it is not income, but, if you like, a liability to the government. So that's a VAT liability that you are, if you like, receiving on behalf of the government. And yes, of course, all that money has come into the, all that money, if you like, has come into the bank, or whether we call it trade receivables. Let's just call it trade receivables for now, 4489.20. So the key point here is you have that big figure under trade receivables, you have that as VAT, and you have that as revenue. And really, even the principle, the core principle in accounting of objectivity, of integrity, really lies in the fact that we're only recognizing what it is that is yours, if you like, in revenue. Right, so great. So we have this liability here. And then we have kind of the reverse. What you have here really is a breakdown, isn't it, of what we would consider to be purchases. When we add these two figures together, 1690 plus 1055, we get, if you like, 2745, and when you now add that onto the 549, you get the 3294. So we're really saying that we have a mixture. We have what we consider to be, because we can claim VAT, I'm sure you know, on not just goods for trade or for resale, right? On other expenses, VAT can be claimed as well. And so you have a breakup and a breakdown here. And that is the VAT that you can claim back. So you went into a business and you handed over 3294, if you like. But because, of course, you are a trading business, you are able to reclaim back that amount. A normal person wouldn't be able to do that. They would just be paying that off to the government. But you can claim that off back as so that is, if you like, an asset, a current asset. So a VAT current asset of 549. Now, of course, creating two separate accounts of VAT, asset and liability, is a bit much. So why not just use one account, which is what in effect the VAT statement really is. It's just a T account, recognizing the credits and the debits on the one statement. So maybe, I think, as you're doing it, what's good to always put a little T account on the side as you're going along. So you're putting VAT that you owe, so VAT on sales. And on this side, you're putting VAT. I could use a different pen color. I suggest maybe you can do that as well. Take your time in the exam. There's no rush. You have the reference sheets, VAT on purchases. And that's your kind of starting point. Right. So now, of course, remember this really, in effect, this question of VAT has nothing to do with whether or not we're receiving, where we're only trading for cash on credit. These transactions are just as good as each other, because you will eventually get the money. But the key point really is that we, even on credit, we recognize VAT even when we're selling goods on credit. I mean, after all, the only items, if you can remember, of course, that go in the sales day book and the purchase day book must be invoices, right? These are credit transactions, right? Okay, great. So here we have cash receipts. So we have a scenario here where you have some cash sales, if you like, and you can see that really this VAT is very much, it looks very close to this really. I would almost hazard a guess, and yes, it is 22%. 20% of that, those cash sales, if you like, are the 22. So you can see here that in your receipt book, you will get money, of course, from your debtors. I mean, this is your cash book ultimately, right? That's your cash book. So of course, in your cash book, you're receiving money from debtors, but you're also having, this business seems to have a bit of cash sales. So it doesn't matter if someone comes into your business and buys for cash. They're still going through the same process of paying a top-up, a VAT top-up tax, if you like, that you are holding on the government's behalf. And in effect, you owe the government that 22. So if I was doing the double entry for this, you would have, again, you would have revenue there, and you would have VAT liability, and you would have bank, right? So if you like, you will have your cash sale of 110, and then you'll have VAT. So you'd recognize VAT of 22. You would have the revenue of 110, and you would have received 110 plus the 22, giving you 132. That's what you would have received in the bank, right? Great. So and then literally you can see that. Oh wait, 1 second. Let me just verify that. Let me just be sure that that's not the 22%. The 22 0.2 times 0.2 times 110. Yes, because the 110 is at 100%. If you look at the calculation, you can see this is at 100%, and this is at 20% of this. So they're literally giving us what the cash sale was, and that's the VAT element. So in a cash book, we're able to separate the two. So you did receive 132, which is made up of your cash sale and the 22. Okay, good, brilliant. And so this 22 as well is payable to the government. So this 22 plus, of course, what we were talking about here is you owe that to HMR to see. And in the reverse, you've gone out there and you've bought some goods. You've paid out £72, and that's broken up, if you like, into this £12 that you can claim back because you paid an extra tax of £12 just because the government require it, and you can claim that back. So think of this, of course, as a current asset that you can claim back. Again, double entry it. You can see there we have purchases 60, VAT asset, if you like, 12. If you like, and you pay that out of the bank, you paid 72. So you know that that's on your debit side of your VAT account, and that's gonna, if you like, you can add that on to whatever it is you're going to be able to claim back. So you want to really talk through it in your head to know clearly exactly what's going on. And the petty cash as well. Now you're paying, again, same scenario. Here we are. You've paid that out of the bank. That's sundry, and that's what you can claim back because you're, if you like, paying for goods again. Right, so let's come to the statement. You can see what they've done here. Literally, whoops. Really, again, like I say, this is a double entry, really, ultimately. So what I suggest is put the double entry here, put VAT, and then you have VAT due in the sales period. That's the 770. You know that's over here, 770.20, right? Because you owe that. And you can see it says working one. We know where we've got those figures from. Those figures are made up of our credit sales and VAT on credit sales and VAT on cash sales. We know that. You can see it's there. That's what's from the sales day book, and that was the £22 from the cash receipt book. Right, and let's move back up. Let's go back upwards. Oops, 1 second. Yes, again, let's go back here. Then we have box 2, VAT on acquisitions from other member states. So if you had sold goods to other member states. I don't think that hits your syllabus too much. It seems that, but same thing, if you were selling abroad, you would recognize that VAT here, because you'd be paying that back to HMRC. The truth is that there's a net effect that actually happens with buying and selling goods to an EC member states, but that's not on your syllabus. So you now have the total VAT that you must pay, if you like, to HMRC again, and that's on this side, of course, of your VAT account, isn't it? It's a liability. Now you can claim. What can you claim back? And that's us adding everything from VAT on purchases, credit purchases, VAT on cash purchases, and VAT on petty cash purchases. So all purchases that are allowed. And we can see that says that's working too. Let's have a quick breeze of what's going on over there on working too. You can see that that's the purchase day book, that's the cash payments book, and there's the petty cash book as well. You can claim all of that back. So we literally now have that on the other side, yes, of course, over here of our double entry. So we have the 5A580, if you like, over here. And you know how I've arrived at this, don't you? Because this is really as a result of filling in purchases, trade payables, and VAT. Yes, that's how this double entry. That's the double entry of this. That's the 585 here, and then of course that's the purchase, and then these two will add up to the credit side of trade payables is really the total of this and this. That's the double entry. So that's how that appeared. Great. Okay. Right. Then of course you see the next column literally says what's the net VAT, which is the difference, of course, between the two. So here in effect you have to overall pay off. So there's no need you sending the government a check and they send you a check. You just deal with the net. And in this scenario the liability is greater than the asset. So in effect you have to pay off over to the government 184.40. Now of course as a reference, what the government want to do is to be able to really sort of get in their minds to see whether or not this figure you've declared here is reasonable. So they ask you to include all the revenue or sales for the year in this box, which is you literally writing all your credit revenue plus your cash revenue, as in sales, and to do the same thing here with your purchases, your credit purchases, and your cash purchases. And that's pretty much it. That's kind of your VAT return. I think the bit that might sometimes be a bit annoying, if you like, and irritating is this bit over here. But again, because we're in exam mode now, and I do have, if you remember when we studied advanced bookkeeping, we had to, it might have been advanced bookkeeping, I suspect it was advanced bookkeeping. We had to do some VAT work. You can always go back and watch those videos, but I'm going to go through it again here. And it's this table over here. Maybe this is what you this as well. But just to be clear, it's nothing special. It's all VAT. It's all double entry again. Now these are liabilities. You've charged these VAT, and this is VAT you've charged on sale. These are liabilities, and these are assets, current assets. Right? Okay. So now here's the thing: if you had sold some goods on credit, and therefore you now had to pay, and you of course had a VAT element in it, and you had to pay off that VAT element in it, if you like. So for example, you sold some goods for £1,000, and then of course you had to put £200 on it, and therefore your trade receivable was saying 1,200, and you were going to pay £200 off to the government. But there was a bad debt. So literally, think of it this way. If there is a bad debt or sales return, so you can see all the things I'm talking about. A sales return is really to do with you issuing a credit note. You issue a credit note, there is a bad debt. If you like, I guess these are your classic scenarios. Your bad debt, a credit note, typically maybe any adjustment on errors, but anything that really ultimately reduces the amount of revenue you would actually receive. It's highly unfair, it's very unfair that you should still be paying back VAT related to goods you haven't actually sold, if that makes any sense. So you can imagine that the VAT related to those items must naturally fall on the debit side if you like to reduce the VAT you would have to pay off to the government, right? So this is a liability. So naturally, all VAT on bad debts, sales returns, must fall, if you like, on the debit side of the VAT account. You can see here irrecoverable bad debt, credit notes, if you like, they will fall on this side to do with revenue. And the flip side really must be that if you were going to claim VAT on certain goods, well, if you have returned some of those goods, if you like, well, ultimately, when you're doing the T account, you really should reduce, if you like, reduce the VAT that you'd be able to claim back on those goods, if you like. So that's kind of the real story there. So, yes, and I think that's kind of the way to look at it. I'm not sure. I think what we could do is what I would think would be great. I mean, so when I look at this table, it does seem very kind of noisy, so to speak. But I don't really even trust it as a good T accounting table. What I think is just looking at this, it says VAT allowed on adjustment to previous errors, which you seem to have studied in chapter 6. Net input tax adjustments. Irrecoverable bad debt relief. This is what I was talking about. Less VAT on credits received from suppliers. Yes, I mean this is not good accounting, so to speak, because you can see what they're doing is this thing VAT received from suppliers, they're deducting it here on this side, but really it should just live on this side. I mean, this is a T account, by the way. It's not the statement. So this is VAT allowed on customers. Technically, there doesn't need to be a bracket here. This could technically just be on this side, right? It's just double entry. It's just us making sure we get double entry right. So what I suggest is that you maybe do a question and send it me and let me see how you get on, and then just kind of take a picture of the question. But if this overview was enough, that's great. But please, if there's a particular question you've done and you're not quite happy with it, I think that's always the best way to test this. Do a question, and then whatever you missed, then just let me know, and then ask me why, and then allow me to have a better view of where exactly the niggle might be. But please, this is an interesting exam, because I think it has a false sense of security where you think, oh, you have all the material, but you really want to do the questions because you might not have time to reference all the material. Okay, great stuff. Good luck, and I look forward to hearing from you.